This presentation is merely a brief overview of the topics covered in the chapter and should not be considered a substitute for reading the chapter. This chapter covers the ways we can make money with stocks, defines the market, explains what mutual funds and exchange-traded funds are, gives us some ways of knowing when we might want to buy or sell, and helps us avoid some of the more common problems investors face when investing in stocks. There are two ways to make money on stock. Most people think of buying low and selling high when they focus on how to make money in stocks. This is known as price appreciation. If we buy a stock at $20 per share and sell it at $50 per share, we make $30 per share. There is another way to make money with stocks. Some stocks pay dividends. A dividend is a financial reward paid to the owners. Usually it is a percentage of profit made by the company, but sometimes companies pay dividends even when they lose money. Let's take a look at an example of making money via appreciation and via dividends. This is a quote for Apple. If you look at the dividend and yield circled in red, you will see that Apple does not pay a dividend. They are a high growth company, and they reinvest all of their profits back into the company so that they can hopefully make even more profit going forward. Since Apple does not pay a dividend, investors are only able to make money with Apple stock through price appreciation. That is, by buying low and selling high. Investors have had plenty of opportunities to buy low and sell high with Apple over the past 5 years, as this chart shows. Apple shares could have been purchased at under $100 per share in 2006, 2008, and 2009. It then could have been sold for over $250 in 2010 or over $350 in 2011. Apple keeps growing profits, and as it does, its stock price appreciates. This is a quote for Microsoft. If you look at the dividend and yield circled in red, you will see that Microsoft does pay a dividend. It is listed here as 16 cents. So this quote shows Microsoft's last quarterly dividend. Some sites show the annual dividend, so be sure you know which you're looking at before you make any decisions regarding a stock. On an annual basis, 16 cents paid quarterly is 64 cents. So if Microsoft paid 4 even quarterly dividends of 16 cents per share, shareholders would receive 64 cents per share in a year. This 64 cents in dividends in a year works out to be a yield of 2.47%. We can calculate the yield by dividing it by the stock price. This chart shows that investors in Microsoft have not had quite the same excellent opportunities to buy low and sell high over the past 5 years that investors in Apple have had. But they have enjoyed quarterly dividends every quarter for the past 5 years. Take a look at 2009. It would have been possible to buy Microsoft at the beginning of 2009 for $19.71 per share. An investor who did so received 13 cents per share in dividends each of the 4 quarters of 2009, so 52 cents in total. That investor enjoyed a 2.6% dividend yield and never had to sell the stock to make that money. Perhaps if he or she were particularly savvy, they might have sold the stock at the end of 2009 for $30 per share, making over $10 per share in price appreciation, which is a 52% return on investment. What do people mean when they say something like, the market was up 100 points today, or the market gained 1% today? Well, it is very likely someone making such statements is referring to the stock market. In particular, it is likely they are referring specifically to the Dow Jones Industrial Average, which is comprised of 30 large companies headquartered in the United States. Knowing how these 30 companies did today, last month, or last year gives you more information about the stock market than any individual stock quote could do. Still, there are other stock indexes, that is, groups of stocks combined in a single price report, that someone speaking of the market might mean. Let's take a look at the other possibilities. Here we see a chart of the Standard & Poor's 500 index, which is made up of the stock of over 500 large U.S. companies. Since the Standard & Poor's 500 index is comprised of the stock of 500 companies, it is a broader measurement than the Dow Jones Industrial Average. Many people today speak of beating the market as their goal. When they say they want to beat the market, it is possible, and maybe even likely, that they mean they want the return on their investments to be greater than the return on the S&P 500 index. You can see from this chart the S&P 500 index has performed very well over time. The author of our book mentions that he's not a fan of the technology-heavy NASDAQ Composite Index, but you should know that it is often quoted. Take a look at this chart and notice that it is easy to spot the peak of the tech bubble that burst in 2000 and bottomed out in 2002. While the NASDAQ Composite does have some non-technology companies, it is still industry-specific and very technology-heavy. So investors should be aware that it may pose more of a risk because it is less diversified than many other indexes. This chart is of the Russell 2000 index, which tracks 2,000 smaller U.S. stocks. The stock of smaller companies tends to be a little more volatile than the stock of larger companies. Of course, there are many more indexes than the ones in this video and in the book. If you want to see any of these indexes, U.S. or foreign, check out Yahoo Finance. They have a great list with historical prices and charts. A mutual fund is a professionally managed type of collective investment scheme that pools money from many investors to buy securities, usually stocks. Mutual funds allow a small investor to achieve diversification without needing to buy stock in many individual companies. Most mutual funds have a professional fund manager who buys and sells investments in accordance with the fund's objectives. It is also possible to invest in an index mutual fund that holds the same stocks as the index, therefore providing the same return. Many investors choose a Standard & Poor's 500 index fund to achieve diversification by holding stock in 500 large U.S. companies and gaining the same return as the S&P 500 index, less fees. All mutual funds charge fees. Professionally managed funds charge higher fees than index funds because index funds do not require professional managers to make decisions or buy and sell often. Professionally managed funds usually charge about 1% to 2% of your total investment in fees each year. Index fund fees are usually 0.2 to 0.5%. We'll cover mutual funds in more depth in Chapter 8. Exchange-traded funds, or ETFs, are relatively new types of investments. They offer the pooling of money for an investment purpose that a mutual fund offers, but they trade on stock exchanges. There are ETFs that mimic the returns of stock indexes, ETFs that specialize in certain industries like banking or technology, and ETFs that allow investors to mimic the returns of commodities like gold and oil. We'll spend a little more time on ETFs in Chapter 8. If you would like to learn more about them or mutual funds now, Yahoo Finance has some excellent information located under the Investing tab. Should you pick individual stocks? The author believes that the vast majority of people are better off not picking their own individual stocks. Take a look at Table 5.1 for a list of good and bad reasons to pick your own stocks. We'll cover picking individual stocks in depth in the next chapter. There's no foolproof system for knowing when to buy low and when to sell high. Attempting to time the market is not a good idea. The simplest and best way to make money in the stock market is to consistently and regularly feed new money into building a diversified and larger portfolio. Whatever you do, resist the trap that many small investors fall into: selling after big price declines and buying after big price increases. In January of 2008, the Dow Jones Industrial Average was at 12,600, and surely some bad investors poured money in only to sell in February of 2009 at 7,000, losing nearly 45% of all the money they invested. Had they instead held on, they would have earned nearly all of that money back by February of 2011. And if they had consistently and regularly fed new money into their investments, they would have made money over that same time period. Anytime you're dealing with a finance professional, know how he or she is compensated. Do they make money only when you trade? If so, might they encourage you to buy and sell more often so that they make more money? Do they make more money if you buy a certain professionally managed mutual fund than if you buy an index mutual fund? If so, might they try to sell you on the professionally managed mutual fund and downplay the index mutual fund? If you know how the finance professional you deal with is paid, you'll be better able to consider their advice. Some investors get in and out of investments quickly, perhaps holding a stock only for a few hours or even a few minutes. This is more akin to gambling than it is to investing. Resist the temptation of easy money. Be skeptical when you hear success stories about how much money has or can be made in quick trading. Many people became day traders in the late 1990s, quitting their jobs and trading stocks for a living. Nearly all of them lost money and had to quit day trading and find another job. Another pitfall to avoid is penny stocks. Penny stock companies are priced low for a reason, and that reason isn't because they're good companies or good investments. The author does a nice job of describing how some brokers push penny stocks because they make good money doing so, not because they're good investments for you. That is the end of this presentation. I hope you enjoy reading the chapter.